So we're halfway through 2024 and investment markets for the year have been decidedly mixed as U.S. large companies continue to lead with NVIDIA more than pulling its weight. In the first 6 months of 2024, the AI superstar has seen its stock price appreciate by just under 150%, which represented about 1/3 of the total gain of the S&P 500 in the same period. For investors who did not own NVIDIA, they might be experiencing some ROMO, R-O-M-O. And I'm not referring to Tony, either on the football field or the golf course, but ROMO as regret over missing out. Not owning NVIDIA would have been a big drag on portfolio performance. Of course, with hindsight, pretty much everyone wishes they'd owned even more of the chip maker. We'll say more about NVIDIA and the Magnificent Seven big tech stocks after a quick market review of the second quarter and the first half of 2024. So the Federal Reserve has left its benchmark interest rate unchanged during 2024 so far, while inflation readings have been up and down, though maintaining a relatively tight range. The popular inflation measure, year-over-year CPI, the Consumer Price Index, started 2024 at 3.35%. It fell to 3.09% through January. By March, had risen back to 3.48 before dropping to 3.27 for the 12 months ending in May. Now, the Fed has indicated that 2% inflation is still their target, so they believe their work in reducing inflation is not yet complete. In the big picture, the economy has demonstrated resilience and growth, even as the Fed attempts to slow it enough to keep inflation dropping. Unemployment has risen slightly, but is still historically low at 4.1%. And GDP estimates, well, they've lately risen back to a healthy annualized 3%. The Fed's opinion regarding these and other measures is that it is too early to declare victory over inflation, and that's the necessary condition before they lower interest rates. Now, the Fed's stable position on rates has not kept market interest rates quite as steady. With each new inflation reading, investors change their forward expectations on what rates may be in 6 to 12 months, and as a result, bond yields have varied from trending lower when inflation seems to be lowering, and then moving higher if inflation ticks up. Markets are always attempting to be forward-looking. For the second quarter of 2024, stocks in emerging market countries led the way, rising 5.4%, followed by large companies in the U.S. with the S&P 500 up 4.3%. Short-term U.S. Treasuries with maturities between 1 and 3 years were up about 1%, while the broader bond market measures were relatively flat for the quarter. For the first half of 2024, bonds broadly have seen their prices fall as market rates were slightly higher at the end of June than 6 months earlier. However, yields on bond portfolios have continued to adjust higher, with the average yield to maturity of the Bloomberg Aggregate Bond Index standing now at 5%. While the last 6 months have had the usual ups and downs, over the last 12 months, investors in virtually every major asset class have been rewarded with returns close to historical averages, or, in the case of U.S. large company stocks, returns more than twice the long-term historical average. From June 30th of 2023 through June 30th of 2024, the S&P 500 index of U.S. large company stocks is up over 24%. Emerging market stocks are almost up 13%. Foreign large company stocks in developed markets are up 12%, and small cap stocks inside and outside the U.S. are up over 10%. Bonds are continuing to recover from 2022's interest rate environment and have been positive between 2.5% and 4.5% over the last 12 months. Now, of course, there's always something to be concerned about, and that's the job of pundits, opinion page writers, and financial commentators. The Magnificent Seven, which includes Microsoft, Apple, NVIDIA, Amazon, Alphabet or Google, Meta, and Tesla, well, that Magnificent Seven was responsible for 60% of the S&P 500's 2024 total return through June 30th. This data point has caused some investors, along with financial journalists, to wonder if the market is too dependent on the performance of too few stocks. It's really a reasonable question. An example of this is James McIntosh's Wall Street Journal article entitled, "NVIDIA's Success is the Stock Market's Problem." In the article, he writes, quote, "My worry is that the market is overly reliant on just one stock, NVIDIA, which on its own accounted for 1/3 of this month's gain in the S&P 500 before Thursday's pullback and 44% of the gains since the start of 2022. The journal article's headline reads like this to me: good news, maybe bad news. Now, as I've thought about this same issue, I've found two helpful ways, I think, to look at the current concentration of value and performance of the global stock market. The first is to consider the mindset and strategy of a venture capitalist. Most venture capitalists invest in a portfolio of very small but promising companies. And while they think all are promising, they know through experience to expect that more than half will fail. 2 or 3 companies will at least not lose money, but 1 or 2, well, they'll be home runs. It is the outsized return of those 1 or 2 that will more than make up for the losses realized by the 5 or more that went to zero and those that never grew. The U.S. stock market so far this year has seen the average stock in the S&P 500 index deliver a return of 5.1% when each stock in the index is equally weighted in the calculation. However, the S&P 500 index is not equally weighted, but capitalization weighted. In a cap-weighted index, if Microsoft represents just over 7% of the index's overall value, then Microsoft's performance will represent just over 7% of the index's return. In the equal-weighted index example, Microsoft's return would only represent 1/500th of the index's reported performance, a minuscule amount. The cap-weighted index is the one reported in the news media, and it is up 15.3%, or almost 10 percentage points more, for the last 6 months. The mathematical explanation of the difference is that the largest stocks as a group are up dramatically more than the average stock, while many of the rest have not seen nearly the percentage growth, a large number of them actually seeing share prices decrease. Of the 500 stocks in the index, 321 had a positive return for the first 6 months, while 179 saw their share prices decline. Now, if you're thinking more like a venture capitalist, you'll accept the 179 decliners because your 321 advancers, well, they more than made up for the negative returns. And your one biggest winner, NVIDIA, well, it accounted for about 30% of your total return. You benefited from owning it, but you were still diversified enough that if it or any others of the Magnificent Seven had done poorly, your portfolio would still have been positive. Now, I think the second thing to keep in mind is that the concentration of returns among the biggest stocks is not uncommon. And the companies that make up the top 10, well, they just change from decade to decade. Of the largest 10 companies in the U.S. in 2010, only 2 are still in the top 10 today, 14 years later. Only 1 from the year 2000, 24 years ago, Microsoft, remains in the top 10 today, and none of the top 10 from 1990 remain among the 10 largest U.S. companies today. Today's 10 largest companies represent about 29% of the total U.S. market, almost 36% of the S&P 500. It is relatively high, but it is not historically the highest concentration of value, especially when considered globally. In a recent paper by Michael Mauboussin and Dan Callahan of Morgan Stanley, they conclude that, quote, the current concentration is high relative to the levels 10 years ago, but has plenty of precedent, unquote, meaning it's happened before. Now, globally, stock market concentration is not unusual, and in many cases, it's actually higher than in the U.S. Australia, Germany, and South Korea, for example, their top 10 companies represent over 40% of their country's stock market capitalization. So, levels of concentration increase as some companies outperform others, causing their stock prices to rise and their share of market value to grow. As Jason Zweig noted in his column, The Intelligent Investor, quote, the market's biggest companies have gotten so big, of course, because they've hugely outperformed everything else, unquote. It's good while it lasts. But as the rotation by companies in and out of the top 10 each decade shows, it is hard for the previous decade's big winners to keep winning at a rate higher than all others in the market. Zweig concludes, quote, I think diversifying is vital in case that dominance dwindles, end quote. Who will be in that group of big winners 10 years from today? It's really impossible to know. But if history is any indication, the future list will look very different from the list we have today. I would slightly modify Zweig's statement to, quote, I think diversifying is vital for the day when that dominance dwindles. James Clear, in his 123 weekly email, recently wrote, quote, "Do not mistake a confident explanation for an accurate prediction. Strongly held opinions about what will happen in markets or sports or politics have little predictive power. A lot of what you hear can be summarized as confident but inaccurate," end quote. As always, there's a lot of noise out there trying to get our attention. In the financial industry, people are already talking about trades in anticipation of November's election outcome. Now, we'll have more to say on the futility of political portfolios in future episodes. But today's takeaway, though, must include Foster Group investment principle number 3, trust markets. Investors who always hold a broad market portfolio as Foster Group advises will likely own the big winners, even before anyone knows who those companies are, and they will benefit as those companies succeed, sometimes dramatically. At the same time, owning the entire market diversifies the risk of a catastrophic loss if and when a particular company makes a misstep or just falls out of favor. Like the venture capitalist, a diversified portfolio will own winners and losers with the idea that the unpredictable winners will more than make up for those that underperform. Now, we believe that educated optimism is an antidote for anxious uncertainty. Optimism that is based on solid education helps investors to understand that feelings of ROMO, regret over missing out, are based on perfect hindsight, which, if we're not careful, can give rise to the myth of perfect foresight, tempting us to abandon market-wide diversification. Our goal is for these podcasts to contribute to you becoming educated and prepared optimists. If there are topics or questions you'd like us to address, please let us know at our website, www.fostergrp.com, and click on the words Financial Perspectives. And if you're listening to this as a podcast, you can help us spread the message of educated optimism by liking us on your podcast app. As always, thanks for investing some of your time and attention with us today.